Awesome. So today's session will be about better business through better records. We have a great guest coming straight from the IRS to provide some insights on, how these action items can apply, especially with this upcoming tax season. So while we continue to wait, next slide, please, Rochelle, I'd encourage everyone to follow us on LinkedIn. You can just put the QR code through your phone so that you get linked to the page immediately. We do post a lot of informative content as well as keeping you guys up to date on the MQ&A sessions, so upcoming speakers and topics. So we definitely appreciate the support there and definitely look forward to connecting with you guys on that platform. So I'll just give you guys a minute or two to do that before we introduce our guest speaker and move along with the session. While we actually do that, I do want to go over a couple house rules. So we would prefer if you guys have all of your questions held off until the end. We do have a dedicated Q&A section. But if you do have anything pressing, then you're more than welcome to ask it in the chat or raise your hand. Both of those icons are in the nav bar of your screen, so feel free to use those if necessary. But other than that, without further ado, I would love to introduce our guest speaker, Sherri L, Public Affairs Specialist from the IRS. Sherri, please introduce yourself and talk a little bit about what you do.
Hi, everybody. I am Sherri, and nice to meet everybody, and thank you for attending today. I've been with the IRS for 29 and a half years. I started off in a budgetary role in our facilities department, and then I became a revenue agent for 17 years until my current position as a public affairs specialist. So a lot of what I talk to you today about business record keeping comes from my experience as a revenue agent when I used to audit small businesses. And the small businesses that I audited had assets up to 10 million. They varied in size of employees, how large they were, but always all business success stories all come down to having great records. And that's what I'm going to talk to you today about.
Awesome. Thanks, Sherri. We'll move right along into it.
Okay. So we're going to talk about initially record keeping uses. So you might be thinking, why do I need to keep good records? Well, there's a number of good reasons why. And the first one we'll get into is monitoring the progress of your business activity. So you need to have good records to monitor the progress of your business. Your records can show whether your business needs improving, what items are selling versus what items are not selling, and any changes you might need to make based on the successes and what's not so successful in your business. So good records, bottom line, will increase the likelihood of the success of your business. Also, you want to prepare financial statements. So preparing financial statements, you need to have good records to prepare accurate financial statements. And these are going to include your income statements, your profit and loss statements, your balance sheets. And this is going to help you deal with your banks and creditors when you're trying to get credit to have loans to maybe expand your business. Having accurate records are going to help you with that. It's going to help you manage your business as well. And then identifying the source of your receipts. So you can receive money or property from many different sources. So your records are going to identify the source of your receipts. I use it as an example. You might be selling items online, you could be selling things retail, but being able to identify where your source of income is coming from is going to tell you where you're most profitable. And you also need to have this information to separate your business and non-business receipts, which otherwise it translates to taxable versus non-taxable income. You don't want to pay taxes on something that's considered non-taxable. So that's why it's good to have good business records to identify that. And so then you also want to keep track of your deductible expenses. And so you may forget expenses when you go to prepare your tax return at the end of the year. So you want to have a good record keeping system in place so you make sure you take all the deductions that you can take. And speaking of tax returns, you need good records to be able to prepare your tax return. Because I don't know if you realize when you sign your tax return at the end of the year, you're signing that your return is complete and accurate. So good records are going to make sure that you are filing an accurate, true tax return. And then also you need supporting items. You want to support the items that are on your tax return. So by keeping good business records, you're going to be able to do that. If you're ever audited from a IRS audit, an IRS agent's going to always ask you for your records to substantiate what's on your return. So that's why you want to have a good record keeping system in place. On our next slide. So record keeping uses. So you may choose any record keeping system that's suited to your business that clearly shows your income and expenses. So except in a few cases, the law is not going to dictate to you what kind of records you need to keep. However, the business that you're in will affect the type of records that you're going to keep. So for federal tax purposes. Also, your record keeping system should be able to include a summary of all your business transactions. And the summary is only made part of your business records. It's going to include your accounting journals and your ledgers, and it's going to show your gross income along with your deductions and credits. So, but believe it or not, for small businesses, one of the biggest books that you're going to keep that's going to really substantiate your business is your business checkbook. On our next slide. So supporting business documents. So this is going to be the items that actually supports your record keeping. So this is going to be your invoices, your receipts, your payroll, your sales, and your canceled checks. And I want to highlight here also Publication 583, an IRS publication, outlines all of this. It's called Starting a Business and Keeping Good Records, and it goes into all the details about these categories. On our next slide. So publication 463, which is a different publication, talks about travel, transportation, entertainment, and gift expenses. So you need to have proof of certain types of business expenses, and different expenses are going to have different types of receipts. So if you deduct the travel, entertainment, gift, or transportation expenses, you must be able to prove substantiate a certain element of the expense. You might be thinking, what does she mean by element? The element is the business purpose of the expense, because sometimes it could also vary into being personal. Some expenses can have an element of both. So you need to be able to substantiate when you're putting it on your tax return that business element. And so for additional information on how to prove that certain business element, if you refer to 463 publication, it'll get into that. And then there's also a great table at the back of publication 463 called Table 5.1 that gives you all kinds of information about that category. On our next slide. So I want to get into your car expense deduction. So when you're deducting your car, it could be a car, it could be a truck, it could be a business van. You want to be able to substantiate the business purpose. So sometimes people commingle. They only have one vehicle. They're in a small business, and they use it for both business and personal. Or you could actually use your vehicle all for business. It's going to have the same type of deduction as far as there's two ways to deduct that vehicle. You can do what they call the standard mileage rate, or you can do actual car expenses. So the difference between these two is a standard mileage rate. You're just taking all your business miles, you multiplying it by the mileage rate, where the actual car expenses, you can take your depreciation, your repairs, your tires, licensing, registration fees, gas, oil, insurance, lease payments. But the big difference, though, is if your car is 100% for business purposes, then you're going to take 100% of the actual expenses versus a standard mileage rate. You take the mileage for that car 100%. But when you get into commingling both the personal and the business, then you have to come up with a percentage of your vehicle of personal versus business. And I'm going to have you go to the next slide. So, and then I'm going to go to a couple slides. So this slide right here basically talks about the standard mileage rate. So for 2025, it's 70 cents. Usually this is inflation based, the rate. And sometimes if inflation goes up in the middle of the year, they will change that rate in the middle of the year, but typically this rate will be for the entire year. And then also, if you notice on the slide, it also talks about how it's good for the electric and hybrid electric automobiles as well as the gasoline and diesel powered vehicles. If you go to the next slide. So some of the documents that you might need for your assets. Now, I'm going to back up here before I get into that because for some reason I thought I had a slide here that talked about the business versus personal use. So on your vehicles. So on your vehicle, when you have business and personal, so suppose you use your vehicle in the daytime for business, and then at night you're using it to take the kids to school, for school plays or sports, or you're going out to dinner with friends. You want to have a good system in place to document your business versus your personal. There's different ways you can do that. Some people have a calendar. They write down when they leave their house to go do business type expense or mileage. And then when they get home, they write down the ending day mileage for their business. Other people might use an app like the Mileage Quest app, where they can document their business miles, and then at the end of the day, then they have their personal miles. But when it comes to actual business expenses, you have to have that business percentage. So what you would do at the end of the day, you have your business percentage, but then you want to look at your total miles to determine what your total miles are. You subtract your business miles, and that's how you come up with the personal miles. So when it comes to actual expenses, you really need to know what the business percentage is. When you take the entire actual expenses, you will multiply it by the business percentage to get what your business deduction is. So on this slide here, talking a little bit about assets. So when you're purchasing your asset, whether it's a vehicle or any assets in your business, some people might be they might be building owners and they're renting it out. Like they might have a office building, and they're renting out space to different businesses. You want to have good documentary evidence, so you want to have something that shows the purchase price. In the case of a building, you're going to have like the mortgage documents. Any improvements that you do, whether it's to your car or to your business or any asset, you might have machinery and you might have to fix that machinery. You want to have any repair invoices. You want to keep those. The same thing for depreciation. When you're deducting your depreciation, you have to prove the purchase price of that to take the useful life, to take that deduction, and how you use the asset. So if it, again, we were talking about a vehicle, are you using it both business and personal? So that's where you want to get that business percentage. And then if you ever dispose of the asset, when and how you dispose of the asset. If you are in a business that's a corporation and you sell it to a shareholder, there's going to be different rules that apply to disposing an asset and how you deduct that final sale. And then when you go to sell your asset, you want to make sure you have the mortgage document or the sales slip that shows that you sold your vehicle, because if you sell it, or the asset, because if you sell it at a loss, then there's ways to deduct that as well. And then the expenses of a sale. So obviously when it comes to a building, you're going to have like an escrow company and title transfers, and they all incur expenses. The same thing with a vehicle. Maybe you are incurring expenses through a dealership to sell that vehicle. On our next slide. So record keeping timeframes. So this is so important. A lot of times people feel, you purchase a vehicle, you put it on your tax return, you don't need to keep those receipts anymore. But anything that you're going to keep that has a useful life, especially if you're depreciating that asset, you want to keep those receipts for the life of the asset and then add 3 years on top of that. And you might be thinking, well, why am I adding 3 years on top of that? Well, because a tax return has a 3-year statute. So as an example, right now, we just finished 2024 tax year. So you're going to be filing your tax returns in 2025. So the date you file your tax return starts your statute, and you have a 3-year statute. That statute will expire in 2028. So you want to keep your records at least through 2028. So I'm going to go to an example of a building. So you purchase a building. Maybe you purchased that building in 2010. Anything you do to that building from 2010, we'll say you plan on selling it in 2030, You want to keep all your improvements, anything that you add to that building that's of value, any kind of equipment that you put to the building. If it's like a big commercial building and you're putting large air conditioning units on top of the roof, any kind of heating systems, all that adds value to your building. It's capital improvements. You want to keep those receipts because when you go to sell that building, we'll say in 2030, these are going to be all items that you can offset whatever profit that you had on that building as expenditures you applied to that building. So you definitely want to keep the receipts for the life of the building and then those 3 years. Um, see here, I'm looking at making sure I covered everything here. And then sometimes you might feel, well, records that are no longer needed for tax purposes. But one thing I want to clarify is when you're in business and you might sustain losses, those losses for tax purposes can be carried forward. And each year they change how long the losses can carry forward. But I want to say they're 20 years. You might have sold your building, we'll say in 2020 you sold that building, but now it's 2025 and you're still carrying that loss forward. Because you're carrying a loss forward, as long as you have that loss and you're carrying it forward, you want to keep those receipts because if you're ever audited, they might want you to show how you sustained that loss and why you're carrying it forward because you haven't had enough profit to offset those losses. So anytime you're in a situation, and I'm talking Schedule D, the loss, gains and losses, but you also want to keep your receipts for as long as you have a loss carry forward. If you go to our next slide. So I've had questions in the past about electronic records. A lot of times people feel that they have to keep their original documentation. Um, Nowadays, the way technology is, a lot of the receipt paper tends to fade. So for record keeping purposes, by all means, you can make copies of your receipts and keep them in a digital folder. You don't have to have the original as long as you have a good copy of that receipt. And it is acceptable by the IRS. If you're ever audited, they will allow you to provide electronic records. And if you notice here, I even say it saves time and money. It's a lot easier to store a flash drive than it is a lot of different paper documents. But you want to make sure, though, that the essence of the deduction is captured in what you're recording in the electronic records. On our next slide, let's talk about adequate records. So your records have to have, I talked about before, the element of an expense. So you want to make sure you have that documentary evidence that you're capturing the essence, like the date, the amount, what you're purchasing, the details of, the transaction. You want to make sure your evidence is adequate evidence. For example, you want to make sure the name, like if we're traveling, we'll talk about traveling like for a hotel. You want to make sure you have the name and location of the hotel, the dates you stayed there, um, any separate charges like lodging, meals, phone calls, like a restaurant receipt. You want to be able to prove that it's for business purposes. So what I always used to tell people in my audits is when you have a calendar and you're taking a client out for lunch or dinner, write down the name of the client on your calendar and what you talked about, the business purpose. This way, if you ever are audited, you can show, well, yes, I met with Smith and Smith Company and we had dinner and we discussed a project proposal. And so this way you're giving that extra evidence to show that there was a business purpose to that. And it holds true when you're traveling with your vehicle. When you leave your home, you're traveling for business. On your calendar, if you're going to your clients, if you're going to the bank, if you're going to the post office, your shipping items, you always want to put that adequate evidence on there. Canceled checks also act as a receipt. The only problem with the canceled check is if you are writing a check, we'll say to Costco. Costco can be for both business and personal, so that's why sometimes with a check you also want to make sure you have that receipt to show that what you purchased was for business purposes, because unfortunately some places have items that can also be personal. Um, Let's see here, duplicate information. So you don't have to record information in your account book, or you just want to be consistent in how you're recording information. And I'm going to use an example of a supplier. One time I audited somebody and he had all of his invoices that he received for each supply order that he purchased, but then at the end of the month they'd send an account statement. And this individual accidentally double counted everything because he had his invoice statements, then he had his month-end account statement. So you want to be careful not to duplicate information. You want to be consistent in how you do your record keeping, but keep that in mind that sometimes things do duplicate themselves. And you want to have timely kept records because I'm going to use the example of when I would audit people and they didn't have a good record keeping system. So what I used to suggest is take a Schedule C. It has all the different tax categories on that Schedule C and create file folders. And as you are incurring expenses, put them in the file folders based on the Schedule C tax categories. This way, at the end of the year, you know you have your records for the year because you've kept them as you went. If you don't do this, and then you're going to do your tax return and you're going back trying to find records, you might have misplaced records, but it won't be, you can't go back after the fact. You could always go back and amend your return, but then it becomes timely. So that's why it's good to keep your records as you go versus trying to go back after the fact and re-record your records. And I just talked a little bit about the proving the business purpose, and to me, the calendar is the best way when it comes to travel, to meals, those type of expenses, and then also purchases for places that are both business and personal. And confidential information. I always recommend that if you're dealing with your clients, that you're keeping confidentiality in mind. Just like today, I think I forgot to tell you in the beginning, when you ask questions, we ask that you don't share personal identifiable information because you don't want to disclose that to other people. And then on our next slide, this is an example of a daily business mileage and expense log. So here you'll see that you have the date, you have like where you're going. It could be for traveling for a conference. It could be going to a restaurant. Here you would put your business purpose. You could put your client's name. You could put the if you're going to a conference, what classes or workshops you were attending, your start stop miles. And then also any expenses you incurred, like tolls, gas, etc., and the dollar amounts. Now, this is something that's like a paper log, but I know Mileage Quest is going to go through a better record keeping system that they have that's electronic that will pretty much do that same thing. And then on our next slide, again, this is for car expenses. If you notice, they have Schedule A or business because you are also able to deduct mileage for medical. So here you can also keep track of that there. And then again, it gives you information about hotel and motel and so forth. And then on our next slide. So what I'd like to do is talk a little bit about our IRS resources. IRS, I know I'm biased, but I feel our IRS resources are phenomenal. They're very helpful. They're very user friendly. And if you want, you could take if you take your phone out, you could take a picture of these pages. So if you go to the irs.gov, there's a search engine in there, and you can put in Pub 583, and it'll automatically bring up starting a business and keeping good records. You can go to irs.gov and just put business in there, and it'll bring up business record keeping. I'll give you different topics on businesses. Our publication 463, which I talked a little bit earlier about, talks about travel, entertainment, gift, and car expenses. Our publication 15 is our Circular E. It's the employer's tax guide. Publication 425 is our farmer's tax guide. I don't know if we have farmers here today, but there is a tax guide for farmers. On our next slide, our publication 535 talks solely about business expenses. Publication 536 talks about net operating losses. I talked a little bit about that earlier when I was talking about keeping records. you might think you sold the building, you don't need those records anymore after 3 years statute. But if you're carrying forward a net operating loss into future years, you always want to keep those receipts for every tax return for the life of that net operating loss until you've deducted it in full. So even though you might have sold assets and that 3 year period's gone, if you're carrying forward we call it an NOL, keep those for as long as you have the NOL. And then publication 547 talks about casualties, disasters, and thefts, both business and non-business. I sit in California. I know Mileage Quest is in the LA area. Right now, we are going through a lot of different California fires. I know people in North Carolina and Tennessee sustained a lot of floods this year. So anything to do with, casualties and disasters, this will help you to deduct those losses, but also there's some information about recreating records. So, maybe your house burned down and you've lost your records. That will help you to recreate the records you need for your business, for your tax return. Also, there's publication 594, which is the IRS collection process. That's if you owe money to the IRS, it'll give you ways on how to pay it. And then also, I keep mentioning irs.gov. I love our website. If you go to record keeping in the search engine, it'll give you all the information I just taught you about today. I also want to mention that when you go to irs.gov, on the left-hand side of the column, there's information about individual returns, business returns, sole proprietorships, S corps, C corps, partnerships, government entities, nonprofits. There's all kinds of great information just starting at the irs.gov webpage. And with that, I am going to send you back to Mileage Quest and to Bridget.
Thank you so much, Sherri. That was so informative. I really appreciate those insights. Yeah, I just wanted to close out with sharing a little bit of information about Mileage Quest specifically and kind of how we help those with record keeping, in a more streamlined fashion. So what is Mileage Quest? We are an automatic mileage tracking app that basically simplifies that mileage management and logging process for both businesses and individuals. So if we heard anything from what Sherri had to say, there's a lot of information that the IRS is requiring you to document in order to substantiate any claims that you have, mileage related or not, right? And so a lot of the pain points that we have seen, specifically the founders who come from a CPA background, is that manual aspect of it. It's so tedious. Who wants to do that? And with technology readily available for us to take advantage of, Mileage Quest was born. So I'm just going to go quickly into a couple features that directly impact the record keeping aspect. So first is, of course, our core feature, which is the automatic mileage tracking ability. So we do connect to your phone's GPS and are able to track your movement as soon as you're in a vehicle and, going on a trip. We are able to classify these trips through business, medical, charitable, personal, and commute. So we know that there was some discussions early on about how the IRS really needs you to make those distinguishments between business and personal. So having the ability to classify that at your disposal is definitely effective and something that we've wanted to implement into the app as well. And then we also give you, of course, cute little descriptions for those that might not be aware of what the IRS would constitute as a business trip or as a commute or as medical mileage. So this is really great. We pull this information again from your phone, from your GPS, as well as your calendar. So next slide, please. With that calendar integration feature that we have, it is really core for all of our users because it limits the amount of work that they have to do. I know Sherri recommended using a calendar system, and we generally see that many people do. And so being able to have that information pulled, so the client name, the location, the time, is really, really efficient for individuals. And then, of course, you have an aspect of customability, being able to edit those descriptions and whatnot. And then it goes into this lovely mileage reimbursement report or next slide, please, an annual tax report, which is what the majority of our subscribers will be generating right now. So this definitely helps you during the tax preparation process. So instead of coming to your tax preparer, or if you're doing them yourself with a bunch of different documents, you can consolidate it in this one form, and then it shows you the different mileage trips that you've done throughout the year, breaks them down by percentages and by vehicle. And so this is really one of our core features, and we're really excited for, those that have not used Mileage Quest to, try it out. And then lastly, I think actually that might be the last slide. Alrighty, so we'll actually open this up to questions and comments either for Sherri or for the Mileage Quest team about the app. We're definitely happy to answer, or just even if you wanted to comment on the presentation. You can raise your hand, you can unmute your mic, or again, you can use the chat feature that is located at the top of your screen. And can we actually confirm that everyone has the ability to unmute their mic? Oh, maybe thumbs ups.
Yeah, can you hear me?
Oh, yes. Hi, Sean.
Hi, Sherri. Hi, Sherri. Great presentation. I think that Mileage Quest really um, achieved what it wanted to, because the app was developed with IRS compliance in mind. And so, your presentation mirrored up to what it is that we do with documentation. And that's really what the IRS requires. I was a former auditor in San Diego. I didn't get a chance to work with Sherri, but um, one of the biggest things is people didn't document. So when it comes to meals and travel, you got to have all that information documented. And Mileage Quest takes the pain point out of using multiple systems to track mileage and then do your appointments. You select a calendar system, most of which we interface with, and then sync it up, and you don't have redundancy. Everything's done one time. And then inside your calendar, just document really well the description of the meeting, like Sherri said, what you were meeting about, of course, the date and time, location, and the client name, and that's what's done inside of Outlook, Google Calendars, etc. So just wanted to give you a thumbs up, Sherri. Thanks for that presentation.
Thank you, Sean. And what you just said was spot on. And I mean, I know sometimes people joke, oh, too much information, but really when it comes to the IRS, too much information is good information. The more the better, because it helps you to substantiate that business purpose. And that's really what it's all about, is getting that deduction. If you are entitled to that deduction, you should have the deduction. And by giving that information, it will ensure you get that deduction.
Awesome. So we have a question in the chat from Robert. He asked to Sherri, if I discover significant mileage that could have been claimed as a tax deduction while using Mileage Quest, should I consult my tax preparer about amending my return?
By all means. I mean, if you've missed I mean, there's always a cost to amending your return. I don't know how much your preparer charges you, but if it's substantial, by all means, you should.
One thing I
I
also wanted to mention, oh, sorry, was someone else chatting?
Oh, I was just gonna throw a quick question in there.
Yeah,
Thanks.
go ahead.
Wonderful information in reference to the personal use of the vehicle. I've been, I think, doing a really good job through Mileage Quest of documenting those three kind of key features, but I haven't really documented like personal mileage. Can you elaborate a little bit about, like, I guess I should be as well.
As long as if you know what, okay, so another thing I would suggest is on the first day of a year, like January 1st, we're still in the month of January. It'd be a good idea to say what your starting mileage is for the year, and then on the December 31st of the same year to document what your ending mileage is at the end of the year. So, by doing simple math, you can, figure out what your total miles are for the year. So if you are using Mileage Quest and you're keeping track of all of your business miles, well, then the difference would be your personal miles, and that would be a good way to establish a business percentage of your vehicle for the year. If you're certain that every bit of your business miles was documented, then you're going to know how to figure out what the difference is.
Got it. Okay. So then that would take me away from having to do every individual, go to the grocery store or
Right,
just
right.
do that.
As
Got it.
long as
Okay.
you're making sure you're capturing all of your business deduction. I will tell you, for IRS audit purposes, and I'm sure Sean can also attest to this too, we used to ask people to give us their repair receipts for their vehicles, even though they might have taken standard mileage deduction, because usually when you get your car repaired, the dealership or the car repair shop always puts your mileage on your repair receipt. And so sometimes when people weren't really sure about their deductions and how many business miles versus personal miles, that was a good way to kind of get an idea of how much mileage you had throughout a year. Because usually every 3,000 miles you get your car oil change done and so forth. I think Sean had a comment.
I do.
Sean,
I
yes.
wanted to address two. I want to address two things. Mileage Quest prompts you at the end of the year to document your odometer reading, and it keeps prompting you until you do it. So what Sherri said is absolutely correct. You want to be able, you document your odometer reading December 31st of every year. The computer system, the way it's programmed, it knows from 23 to 24 or 21 to 22 what your total mileage was. And so you don't have to document personal mileage in the system. It grabs your business mileage, your medical mileage, your charitable mileage,
Charitable. Yeah.
and then the system takes anything that's not coded and it dumps it into the personal bucket automatically. So that takes care of that. I think Anthony asked that question. And yeah, so I just wanted to say that yeah, Mileage Quest does that. Every year requires you to document your odometer reading at December 31st.
And
That
we'll
was it.
actually have Rochelle show the two reports that question is asked. We have the vehicle information and the vehicle usage reports, which gives like an overview. I think Rochelle's going to share that. But
Let
while we
me
wait,
find it.
I know Carolina had a question or had her hand raised as well.
I just wanted to say thank you and I appreciate sometimes you do your expenses and you think you are dotting all your I's and it's not necessarily true, right? So I appreciate your insight shares, particularly what I did not know was the statute of limitation of the 3 years from the date of filing. That was like totally eye-opening because you can lollygag forever and then do it whenever you think. And I had no idea where the inception of that started. Can you go over that a little bit again? I kind of wanted to confirm. It's 3 years, right?
So your statute of limitations for return is, so what this means is that the IRS can only audit you in your 3 years while you have an open statute. So I use 2024 as an example. So 2024, you would file by April 15th of 2025. So I do want to clarify. So some people file in February, some people file in March. Um, any date before the due date will automatically assign you a statute of April 15th. And then, so April 15th of 2025 starts the statute and it ends April 15th of 2028. Now, if you file an extension to October 15th, then your statute would be any date you file it after April 15th up to October 15th. So the same's not true before it changes slightly. So if you file anytime before April 15th, you automatically get April 15th. You have to timely file an extension to be able to extend it to October 15th, but then it's the actual day that you file it. And what happens is well, if you do like electronically, they have a timestamp because it's electronically. If you file it paper file through the mail, when they receive it at the processing center, they will take the date off of the mail, off the envelope to assign the statute. So when you take it to the post office after April 15th and before October 15th, and then we'll say that you didn't file an extension and you file your return a year late. So we'll talk about using 2024. Suppose you file your return on February 15th of 2026. So it's after the extension, it's after the due dates. They'll base it on the day they receive it, which would be in February of 26. So that would start your statute and then add 3 years. Now for collection purposes, there's a 10-year statute. So from the time that you file your return, they have 10 years to collect a balance that you might owe. Now, I also want to point out that some people forget to file a return. Some people, for whatever reason, might go 5 years and not file a tax return. So what happens is that you have an open statute, which means that the IRS can audit you on any back return that was not filed. So that's why it's so important to get those returns filed, because you want to get that statute started, that 3-year period. You might have 10 years worth of returns. And then what happens is if the IRS catches up and finds you and finds that you didn't file for 5-10 years, then it becomes very hard on your behalf to be able to get the records to show for those years. So that's why it's so important to be timely in your filing, because that's going to be the best opportunity for you to get timely records, even if you have to recreate them. I'm done with that. I'll let
That was
Rochelle go.
awesome. Thank you.
Awesome. I think we see Sean's hand still raised. Do you have any comments, Sean, or is that from earlier?
No, I need to put my hand down.
No
Okay,
worries. With the statute of limitations, I think it's really also a great feature with Mileage Quest is that with that calendar sync, you can go back previous years and document all of your events that are in your calendar and make reports today for them. So depending on how you filed or if you didn't claim the mileage that you should have, then that option is there. And we go back pretty much indefinitely until your calendar doesn't work. So I think that's quite useful for this situation. All righty. Any other questions or comments for Sherri or the team? Right here, we're showing the vehicle usage report, which documents, of course, that odometer reading start and end. And this is generally what also gets generated at the end of the year for tax filing. There you go. Thank you, Rochelle. Vehicle information report. So if you do have multiple vehicles that you're using in between personal, business, what have you, then this is the report for you. Or of course, if you have staff that are on multiple vehicles or overseeing a fleet, then this would be very, very effective for your tax returns. All righty. Well, we're coming up on 2:45. So thank you so much for everyone joining today. I think it was a great and very informative session. Thank you so much to Sherri again, for joining us and being so informative. Everyone will get a copy of the slide deck as well as a recording of the session sent to your email after. And then if you do have any interest in the Mileage Quest app, there'll be links to schedule a demo or to try the app out. So yes, please look forward to that. And with that, we'll hope to see you in 2 weeks for our next session.